Hello everyone, and welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and short squeeze dynamics. Today, we're putting a specific company under the microscope, one that's been flagged by our proprietary screeners, BOXL Corporation, ticker symbol BOXL. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. BOXL Corporation (BOXL) operates in the technology and consumer electronics sector. This company designs, produces, and distributes interactive technology solutions primarily for education, health, corporate, military, and government sectors across the Americas, Europe, the Middle East, Africa, and internationally. BOXL is a microcap stock with a market capitalization of just $4 million. Looking at recent price action, BOXL has seen quite a bit of volatility. Today alone, the stock is up a notable 14.59%. However, zooming out, it's down 14.10% over the last 5 days, but still up 24.90% over the past month. Show chart, BOXL 30-day price action volume-wise today saw only 136,900 shares traded, which is significantly lower than its 30-day average volume of 2,652,293 shares. That's a relative volume of just 0.1x its average, meaning today's move happened on very light trading compared to its typical activity. What is cost to borrow and why it matters? So, what exactly does hard to borrow mean, and why should you care about cost to borrow, or CTB? When investors want to short a stock, they first need to borrow shares from someone who owns them. They then sell these borrowed shares hoping to buy them back later at a lower price and profit from the difference. For the privilege of borrowing those shares, they pay a fee to the lender, typically expressed as an annualized percentage. This is the cost to borrow. When a stock is hard to borrow, it means there's a limited supply of shares available for short sellers to borrow, or a very high demand from short sellers, driving that fee sky high. These can easily exceed 100% annualized, and even reach over 1000% because it reflects the daily demand and scarcity in the market. A high CTB indicates that short sellers are paying a premium to maintain their bearish bets, which can be a key ingredient in a potential short squeeze scenario. Why this stock is hard to borrow right now. And this brings us back to BOXL. Why did it appear on our hard to borrow screener? The annualized cost to borrow fee for BOXL currently stands at an astounding 1168.2%. Highlight CTB number that is an exceptionally high figure. While the exact number of shares currently available to borrow is unknown, a CTB fee this high strongly suggests extreme scarcity in the borrow market. Add to this BOXL's estimated float of just 0.5 million shares and you have a recipe for a very tight supply situation. Our internal composite squeeze score, which combines factors like CTB, borrow supply, float size, and technical setup, currently gives BOXL a 41.9 out of 100. This suggests a moderate, but not extreme, potential for a squeeze based on current metrics. Squeeze mechanics explained. Let's quickly review how a short squeeze typically unfolds. Short sellers borrow shares, sell them, and hope the price drops. If the stock price instead starts to climb, these short positions begin to incur losses. The very high cost to borrow, like BOXL's 1168.2%, adds a significant daily burden to these losing positions. When shares become extremely scarce and the price rises, short sellers face immense pressure. They might be forced to buy back shares in the open market to cover their short positions and stop their losses from spiraling out of control. This sudden influx of buying demand, often amplified by a small float, can create a powerful upward price movement, further triggering more short sellers to cover, and creating a feedback loop. That's the short squeeze. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have very strong conviction that the stock price will eventually fall, and they are willing to pay a premium to maintain their positions. Dilution risk check. When evaluating any potential short squeeze candidate, we always perform a dilution risk check. Dilution occurs when a company issues new shares, increasing the total share count and potentially lowering the price per share. This can severely dampen or even negate a short squeeze thesis, as it provides more shares for short sellers to cover with, or simply adds new supply to the market, absorbing any buying pressure. For BOXL, our review found no recent dilutive SEC filings such as -1s, -3s, or 424Bs in the last 90 days. So, based on recent public filings, dilution risk does not appear to be an immediate concern that would directly offset a squeeze thesis. Recent reverse split watch. It's also important to note that BOXL executed a 1-for-6 reverse stock split on June 22nd, which was 59 days ago. A reverse split reduces the number of outstanding shares and proportionally increases the share price. For example, if you own 6 shares at $1 each after a 1-for-6 split, you'd own 1 share at $6. This effectively reduces the float and resets the share price higher. Historically, many microcap stocks tend to see renewed volatility or a price pop within about a month after a reverse split, as the share count is reset and sometimes new interest emerges. While this is a pattern observed in some names, it is not a guarantee that it will happen with every stock, including BOXL. Its recent timing places BOXL outside that typical 1-month window, but the effects of a reduced float remain relevant. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you watch for with BOXL? A significant short squeeze typically requires sustained buying pressure and, crucially, increasing volume. Today's low relative volume of 0.1x average, despite the 14.59% gain, suggests that while the price moved, it wasn't on broad market participation. For a true squeeze, you'd want to see volume dramatically pick up, signaling strong buying interest that can overwhelm short sellers. Given BOXL's tiny float of 0.5 million shares, the price can be very sensitive to even moderate buying or selling pressure. Keep an eye on the cost to borrow rate. If it continues to climb, it signals increasing stress for short sellers. Also, monitor the available shares to borrow. If that data becomes available, the dwindling supply can intensify pressure. In summary, BOXL Corporation, BOXL, presents some intriguing characteristics for potential short squeeze, primarily its extremely high cost to borrow of 11.68% and a very small float of 0.5 million shares. While the stock has seen recent volatility and a reverse split in its past, today's move was on exceptionally low volume. Remember, high CTB means short sellers are paying a steep price, but it doesn't guarantee they'll cover. Always do thorough due diligence. If you found this breakdown insightful, please hit that like button, subscribe for more deep dives into hard to borrow stocks, and let us know in the comments what other stocks you'd like us to analyze. Thanks for watching, and we'll see you in the next video.